Hi, Casey Hallilay from Wealthology here. During times of extreme market volatility like we're seeing now, I always try to remember to stay the course on my investments. If you have more than 20 years until you retire, it is prudent to stay the course. Like a friend of mine said to me the other day, your 401k is like your face. Don't touch it. And I thought this might be a good time to cover something we cover in Wealthology 201 called dollar cost averaging. Here's how it works. Let's take these two people that each have $500 that they want to invest in this fictitious stock. The guy will take $500 and buy stock at one time in this first period on February 3rd. And he will end up buying 500 shares with his $500. This is a concept called market timing. He is picking a specific point in the market to buy, not knowing if the price of the stock is going to go up or down. The woman on the bottom will use a technique called dollar cost averaging. So instead of taking $500 all at once and putting it into this stock, she'll split her $500 into five $100 pieces and buy little bits over time. So in the first period on February 3rd, she's able to buy 100 shares at $1 with her $100. When the price of the stock goes up a little bit to $1.20, she's able to buy 83 shares using that same $100. When the price of the stock goes down to 60 cents, she's able to buy 167 shares. When the price goes down further to 40 cents, she's able to buy 250 shares. And then finally, when the price of the stock starts to recover a little bit, she's able to buy 143 shares at this last price of 65 cents. So what she ends up doing is she ends up buying 743 shares using the same $500 investment for an average price of 67 cents. She ends up buying more shares when the price goes lower and less shares when the price goes higher, giving her a lower average cost over time. Dollar cost averaging is a much lower risk way of investing, but the problem is when the market feels as volatile as it is right now, it feels scary to stay the course. But one of the most important elements of dollar cost averaging is making sure that you continue to buy when the market feels at its worst, because as you can see, you get the most value for your money when the market is low. I like dollar cost averaging for a lot of reasons. Some of them are these. Number one, you get to buy more shares when the price goes lower, giving you a lower average cost. Number two, it's much more manageable in your pocket, buying little bits over time. Number three, it takes the risk out of trying to time the market and find the exact right time to buy. Number four, it gives you a long-term habit of investing, which I like. Number five, it reduces the impact of the type of volatility we're seeing in the market right now and actually allows you to take advantage of it when the price of stocks go much lower. And number six, it also takes the emotion out of investing. If you have any questions on this topic or anything else, please feel free to email me. If you would like our videos direct to your inbox, please sign up on our website. Thank you so much for watching.